And there you have it, the major indices there closing in the red but up for the week. So let's take a look at how they fared overall. As we see there, the Dow down just about 0.5%. They're down 136 points. The S&P 500 also down about 1%. And the biggest loser of the day, the tech-heavy Nasdaq there, down more than 220 points, losing almost 2% on the day. But let's break down more of this market action with our markets panel, Tim Pagliara, CapWealth Chief Investment Officer, and Francis Stacy, Optimal Capital Director of Strategy. So, Francis, I want to start with you at the end of the week that was. What should investors really take away from this period that we're in?
Well,
go ahead. I'm sorry, I didn't hear your question.
Oh, the question is to Francis first, basically getting her takeaways of the week so far for investors.
Yes, thank you. So there are a number of things that are very fascinating, particularly when we think that we're going to get a Fed decision next week, we're going to get GDP next week, we're going to get PCE next week, we're going to get consumer data next week, in addition to all of those tech earnings. So basically, volatility has fallen off, even though we've had a down day today in both the bond, the MOVE index, and also with the VIX and the VXN, which is kind of remarkable. We've also had a fifth lower high in the 10-year. So rates are really starting to turn around and kind of call the Fed's bluff, despite the fact that we expect a 75 bip move next week from the Fed, in addition to last month's 75 bip move. And so it's just kind of interesting. The dollar has also reversed. I'm looking for the DXY to hold 106.25 to see if this reversal is just sort of like a little bit of a waning in the bullish momentum, or could be something more meaningful. That would also be another early indicator that the Fed may have to pivot before they want to.
And Tim, let me just get your reaction to that. We were talking about the dollar here and also the Fed next week. What are you expecting, 75, 100 bips, and what's the long-term plan here?
Well, I think 75 is pretty much baked in, and that's what I'm expecting. The real issue is there's a lot of talk about inflation is bending down, but we're not going to be anywhere near where the Fed's target of 2% is for a number of years. You know, when you have energy, housing, and monetary policy out of control and shortages and printing too much money, that doesn't lend itself to getting inflation under control. And so how long will the Fed tolerate where everybody be relieved right now to see a 3 to 5% inflation rate? And so if they have to continue the upward move in interest rates following maybe even a little bit of a pause this fall, that's when you'll see the impact that it has on stock valuations and how interested people are, you know, to maintaining momentum in the market.
And I want to follow there, Francis, on that prediction of 2%, not for a couple of years. What are your thoughts on that? And when will we see even the number we just saw in June? When will we see inflation begin to come down? And what will all this force the Fed to do?
Yeah, so it's really interesting. So Jay Powell was very clear that they're going to be focusing on headline CPI inflation. And there is a lag effect. So energy has been obviously a huge participant. And though the energy prices have dropped, there's about a 1 month lag until the energy price change shows up in CPI. Used cars were a big thing, you know, during the pandemic, and they have also dropped off quite a bit, but that has a 2 month lag. Most of the food components have dropped off pretty dramatically. I mean, some of the commodities you would even say have crashed, and that has a four month lag on average. And then owner's equivalent rent actually has an 18-month lag until those price changes are absorbed into the CPI. And those are the underlying mechanics of why CPI stays so sticky. So to Tim's point, if the Fed is focused solely on CPI, which he sort of claimed, I don't think that that's actually true. Yes, then he's going to remain hawkish. The thing is that despite his hawkish narrative and not wavering from the hawkish narrative, financial conditions and bond markets and the dollar have already started to kind of question whether or not he's going to be able to do that. The Fed is not going to pivot because they want to. They're going to pivot because they have to. On the corporate bond index option adjusted spread, we are nearing the level that he had to pivot in 2018. We actually have more debt in the system to service. And we did have a liquidity issue in September of 2019, which reignited quantitative easing before COVID. So because we have more debt in the system, And because we have more credit risk as people use more credit cards and as rates go up, things are harder and harder to service. And now we have very clear signs of demand destruction. So financial conditions have actually started to loosen ahead of that narrative from Jay Powell. And so it's just going to be interesting to see what he says on Wednesday. But traders are already starting to kind of call his bluff, particularly in the bond market.
So then, Tim, in this environment, then, where do you see the opportunities and what are you staying away from right now?
Well, I'd stay away from NASDAQ as an index. In years where NASDAQ's declined 29%, the following year recovery is about 5%. So I would focus on individual names. I'd be very defensive. We like, for example, Williams. Williams is a natural gas pipeline producer. We know we're going to be shipping more natural gas. It has a 5.1% dividend yield. And it's going to be somewhat insulated from a lot of these other bad things that could continue to happen in the market.
And one last question here. Francis, you mentioned the DXY, the Dixie, heavily weighted. It's a basket, and it tracks the euro, the yen, but heavily weighted toward Europe. But I have a chart on the Wi-Fi Interactive here I want you to respond to. We are up again. We are in no man's land if you're applying some technical analysis here. What happens if we go to 120 and we retest these 20-year-old highs?
Yeah, that could be, right? But when you think about the mechanics of tightening versus easing, the dollar being bullish is both a defensive play. And also, when you tighten the money supply, then that increases the value of the currency. And so that's been, the impetus behind the dollar's run. And if Jay Powell remains tight, I can see the dollar doing better. Obviously, Europe, as you say, is weighted and doing worse. And now they've started to tighten there. That's going to be an interesting balance. But the euro has still dropped against the US dollar. So we could test those highs. However, if we start to think that the Fed is going to have to pivot before they finish the tightening cycle that has been projected into the markets already, I see the dollar reversal being key to that. Also, of late, the dollar has been negatively correlated to gold. Gold is sort of quintessentially defensive when you have, slowing growth. So it's just going to be interesting to see how all of that plays out.
Always love talking FX on a Friday afternoon. Thank you for that, Francis, Stacy, and Tim Pagliara.